You've created your trading plan, you are ready to use it, and you might think it's finally time to start making some money. I'm sorry, but you couldn't be more wrong. Because for every single trader, there's 3 phases, 3 steps that you still need to go over, which are step number 1, psychology, step number 2, probabilities, step number 3, experience. Then after going over the 3 steps, you will be absolutely ready to start making some money. Now, before we do that, let me give you some context, because not realizing these 3 steps leads to the biggest trap in the trading industry, which is called shiny object syndrome. Now, let me explain that a little bit further. When I made a trading plan for the first time, I thought that's it. That's the last step you need to take before the money just comes rolling in. But that's simply not true. It's only the start of the journey. Because when you start losing some trades, and like most traders, you think the trading plan isn't working. So you start changing the whole trading plan. You start looking for something quote unquote better, which is not actually better. This is shiny object syndrome. Now, and if you don't control shiny object syndrome, it's going to be the end of your trading career. It will just turn into an endless cycle. Now, you need to understand that losses are a part of the game. Don't assume when you have a trading plan that you'll automatically start winning, because most likely you are not operating the trading plan at its fullest potential. Now, what does that mean? That leads us to step number 1, the psychology phase. Now, when you have a new trading plan and you're looking to use that trading plan, then most likely in your first 10 trades, there are quite a few trades that are not part of the trading plan. That means that when you take losses, it's not the trading plan that's the problem. It's you and me, the human executing the trading plan. Now, having a clear trading plan before blaming psychology is very important, yes. But how many traders out of thousands of traders can actually follow their trading plan without any issues straight from the start? I would say close to 0, if not 0. So what is step 1 psychology phase about? It is about filtering out the trades that we should not take, and we are taking them because we struggle with psychology. So how can we do that? Number 1, I want you to start journaling, because this will give you an idea what kind of trades you are taking and on what basis you are taking those trades. Then after journaling, you want to go through your journal or have someone else go through the journal. Sometimes it's difficult to see your own mistakes. So having someone look at your journal helps a lot. So this is, for example, where the MMT can also help you. Because what we have right here is the notion of an MMT member. In other words, this is the trade journal of an MMT member. And today, you and me are going to judge this MMT member. We have permission, so feel free to. Now, what I want to do right here, I want to see if we can find trades that are based on psychology errors. So pointing out the reason why someone took the trade, or at least try to, of course, because we are not exactly taking trades, we are judging from the outside. There's a lot going on here, but what I want you to focus on is the left side first, so the date right there. Then after focusing on the date, I also want you to focus on the RRR, the risk to reward ratio. So with those 2 sections highlighted right there, you'll start to notice something. And this is the first thing, when I opened this journal, it's the first thing I noticed. And that is the following. You will see that every first trade of the day is a loss. Now, this is something that I immediately recognized from my own trading when I was just starting out. Because when you are quite new to trading and you open the chart, then oftentimes you are very excited to jump into the market, to execute immediately. And especially if you're coming from, I would argue, any other job in the world. When you arrive at work, you need to do something immediately. With trading, that's the opposite. With trading, it's oftentimes a lot of waiting as well. Now, with rushing into the market, oftentimes you lack clarity, meaning you're not focused fully. You're distracted by all the movements in the market. You're too excited, you're too hyped to jump into the market. Now, this is purely an assumption. So how can we now know if this is actually based on some truth? Well, if we start comparing the first trades of the day with the second trades of the day, then we will start seeing, and this is what we'll do in the second phase, so in the probabilities phase, then constantly the second or the third trade is a lot higher probability than the first trade. That to me shows that the second or the third trade after the first loss, was logically thought about. they actually thought about that trade ID, where the first trade was just like, oh, I'm happy to start trading again and let me just jump into the market. Now that is one thing that you can potentially recognize in your own journal as well. Then there's another thing. I want to move on to week 4 in this journal. And I want to look at the trade of the 25th of April right here. Now right here we can see that the MMT member is taking a trade right here based off of that fair value gap to then potentially continue higher. Eventually, price came back towards the entry level, so the trader got tagged out at break even. Now keep that in mind, because if we now move on to the second trade of the day right there, then we see right here, this is the exact same scenario. Where the previous trade was a little bit earlier off of this fair value gap right there, the second trade is based off of this fair value gap right there. Now initially I could understand if you think, what's a fair value gap higher, potentially towards the take profit, not bad trade ID, right? Well, the first thing that I noticed is that you got taken out at break even already earlier on this trade ID. And I want you to think about this very in depth, because if you take a loss already on one trade ID or a break even, that means something. There's a reason to it. When you take a loss or a break even, that means the trade ID is not going in your favor. That's why your stop loss is at a certain area. Your stop loss should be at an area where low probability starts to kick in, where the trade ID is not in your favor anymore. So if that's the case, and then price starts moving in your favor again, that means that you are now trading low probability conditions, which means that just because we have a fair value gap higher at that moment in time, you are losing focus, because this for me is not a trade based on technical analysis. It's a very good trade ID. No, this is purely a trade ID for me based on, oh shit, I don't want to miss out on this trade. I need to enter really quick right here. This is something you can also notice in your own journal. What I definitely noticed in my journal is also marrying a bias. So thinking the ID should definitely play out, then buying until you either blow the account or finally it starts to play out. So based on this trade ID, can we then come to the conclusion that we never want to enter twice on a single trade ID after already getting taken out of a trade? Well, for me, my personal trading plan, yes, that is indeed the case. But for someone else, we need to gather a little bit more data. We need to see if this happens more often as well. And if you indeed see that your trade ID usually plays out, but you get taken out on the first trade, and that means you can potentially look to enter on the second trade in the same trade ID. But if that's not the case, then you don't want to enter a second time, which in this case, it's not the case. So if we filter out the psychology errors right here, then in week 4, that means that -1R right there is gone. So still, week 4 right here is at a loss. Now right here, if we filter out those psychology trades again, and we say, okay, we want to be more focused for the first trade of the day. So try to avoid that first trade of the day, or at least be focused enough where you can avoid it because it's not high probability enough. Then filtering out every first trade of the day in week 3 will remove -0.6R, -0.72R, -0.1R, which comes to about -2.3RR. That would make week 3, instead of a 3RR, it would make it a 5.3RR. Now that of course is a huge difference, because when you then combine week 3 and week 4, then week 4, if you also filter out the psychology errors, then week 4 seems like a minor inconvenience, where you are set back to +4R still, where now it's the case when week 3 and week 4, you are back at 1R. So once you have identified the trades that you can filter out based on psychology, and again, right here, I've gone over losses, but in some journals, it is also the case that you are taking winning trades that you actually should not take because you are FOMOing in, you are revenge trading, over trading, and you got out lucky, and now you're ending up with a winner that you shouldn't actually have taken. Then to filter out psychology trades in the future, you want to start working on them. And the first thing is becoming aware of them. When you are aware of the problem is already 50% fixed. In a similar scenario to this right here with week 3, we could argue, well, pay more attention, have a clear checklist before you go into your day. So you can go into the day more focused. In other scenarios, it might also be the case of reducing your chart time. So setting alerts, walking away from the screen. If you notice you always start your day with a winner, and after you start losing, then limit your trades to 1 trade a day. Now that's phase number 1, because once you have filtered out those psychology trades, there's still work to do, because now we arrive at phase number 2, and that is the psychology phase. In the psychology phase, we need to find the highest probability trades and the lowest probability trades, with obviously one goal: taking more of the winning trades, taking less of the losing trades. Wow. Now, do you need anyone to tell you what is the highest probability or what is the best thing to do for your trading? Someone can help you to fast track that progress, like we do in the MMT, for example, but all you need is your own journal. In your journal, you have all the information that you need to find the high probability and low probability scenarios. Now, I want to take a look at the exact same journal right here, because the winners right here have something in common. The break-even trades right here also have something in common. And the losing trades, besides it also being psychology trades, also have something in common. The first losing trade was taken on Australian dollar, US dollar. Then this right here, the chart that we're seeing, is the US dollar. The thing I want you to note is that the US dollar at this moment in time did not have a sting into this 4-hour fair value gap, meaning it did not have a reason to go higher just yet. It left behind an unmitigated 4-hour fair value gap. Okay, that's not necessarily something to immediately draw conclusions, but if we now start taking a look at the second trade, this trade is again on Australian dollar, US dollar, only 6 hours later. Then here, the same US dollar chart with that 4-hour fair value gap right there at the bottom, which we did not sting into just yet, neither on this scenario. But it does have a 50-minute fair value gap right there, which it can continue higher from. So the dollar can either continue higher right there from the 4-hour fair value gap or the 50-minute fair value gap. Okay, so what do we do at that moment in time? We wait for extra confirmation from the 50-minute fair value gap. That will show us signs if we want to respect the 50-minute fair value gap, continue higher. If not, we could potentially continue lower to the 4-hour fair value gap. The major difference between this trade and the first trade is that in this trade, there's a reason to continue higher on the dollar, meaning we have a retracement into a fair value gap. From that fair value gap, we can actually see higher prices. In the previous trade ID, we were in the middle of nowhere. There was nothing, no PD rate that we could continue higher from at that moment in time. Now, and this is something that gets repeated, because on the third trade right there, also a losing trade, which is again a trade on Australian dollar, US dollar, we will see that the dollar right there has reached an opposing resistance area, meaning the dollar is not agreeing with the ID anymore. It's run into resistance. Very similar to the first trade ID, also a loss, the dollar is again not agreeing with the ID. Now, both these trades, like we mentioned, are also part of the psychology phase, as in they are the first trade of the day, could be a lack of focus. But now we can identify it a little bit more by also saying the dollar is simply not agreeing with the ID in the moment of those trades. Now, this is one thing. The other thing is, if we take a look at those break-even trades, we can see right here that this trade actually was a missed winner. So it hit take profit eventually, and it was not a prevented loss. The first thing that I want you to do when you get a lot of break-even trades is seeing when you hit break-even, does it go to your original stop loss, or does it go eventually still play out and to your take profit? So is it a missed winner or a prevented loss? If it's the case that you only have prevented losses, that means your break-even rule is perfect. If you only miss winners, or the majority of your break-evens are missed winners, remove the break-even rule completely for now, until you have more experience to know when you should go break-even. Because taking a look at this trade as well, it's again an entry which ended up as a missed winner and not a prevented loss. Now here we looked at 2 break-evens. We could argue that's not enough data to completely remove that break-even rule. Perfect. But the first thing we mentioned, that the dollar is not in agreement, is already something that we can actually change quite fast. The important thing is though that you need to filter out those low probability trades as fast as possible. And if you can already spot those patterns quite fast, then you can already take into account certain things for next week. Not necessarily changing the whole trading plan, just taking it into account, adding it to your experience. But if you don't do that and you don't learn from it, then the following happens. Because then you go from week 3 to week 4, for example, and you see here that those same mistakes that you made in the previous week, they get repeated. This is why it's so important to journal. Afterwards, start reviewing your trade, see if you can improve somewhere. Then before you go into the market or before you go into a new week or into a new month, you filter out the low probability trades. How do you do that? By doing case studies, by studying that subject. Well, then what do you even study? You study the exact thing that you found in your journal. So in this case, it's the dollar, not an agreement. So you want to study all your trades that you did take when the dollar was in agreement. Seeing what that looks like in the chart can simply be in hindsight as well. If you struggle with entering on the right fair value gap, and that results in a lot of losses for you, well, before you go into a new week, into a new month, first study that exact subject, entering on the right fair value gap. And this again can be done through case studies, which is simply going into a chart in hindsight, like I'm doing, for example, here in Bitcoin, using the callouts, the annotations right there, and simply creating notes right here around your subject. That way, you might make the mistake another time, but not twice, and not 3 times, and not 4 times, where you keep on hitting the same stone over and over and over. That way you slowly start to filter out those low probability trades. Now, these were only the first 2 phases, and these phases will bring you very far, but they won't reach your full potential. Because phase number 3, the experience phase, that is where you will reach your full potential. We are at a disadvantage when it comes to psychology in comparison to robots, but we are at an advantage when it comes to experience, because we have something that is the most powerful thing in the world, and that is called the brain. A robot follows the same rules over and over and over without having any psychology issues, so you could see that as an advantage. But a human, if you manage to filter out psychology issues, then you can also add traits to your experience. Meaning, if you take a losing trade, you can learn from that without adding a new rule to your trading plan. A trading plan is a necessity, in my opinion, but a trading plan can only take you so far. No matter how good the rules of a trading plan might be, it will most likely never outperform someone with 20 years of experience in the market. That's why I like to have my trading plans 80% objective, so those are my rules so I don't mess up whilst I'm trading, and 20% subjective. That's where the experience is. That's where the potential of the trading plan is. Because when your experience takes over, that's where you gain a lot more RR. That's where your win rate increases a lot more because you are able to filter out bad trades and good trades. A trading plan keeps you on the right track, but experience is where the true potential is. Now, how do you gain this experience? The first thing that is extremely important is sticking to the same trading plan. Because if you constantly switch from trading plan to trading plan, you are going to gain different types of experiences, which might not sound that bad, but if you're going from a supply and demand trader to all of a sudden an algorithm or liquidity trader, that's a completely different logic behind trades. So those will not function well together. They will contradict each other. Then once you stick to the same trading plan, journal and see where you can improve, just like we've done in this video. And when you find things that you can improve on, for example, in this case, when the dollar is not in agreement, then do deep work sessions around that topic. So looking at my own journal for the month of June, I took a break-even trade and a losing trade based on the fact that I traded from a potential breakaway gap, which ended up eventually trading back into the breakaway gap. So what do? I do a deep work session around it. And I even share it with the MMT. That's how I get to certain conclusions. That's how I get to certain concepts, because I study it from my own journal. And this is also how you can improve. The number 4, consistency. Because most people don't journal every single week, every single day, every single month. They give up after a certain amount of time. Most people don't even trade consistent. I am looking at the chart every single day, not trading every single day, but I'm looking at the chart every single day. So I know and I'm aware of what's happening in the market. I'm improving. I'm experiencing certain situations that we've never seen before If you only look at the chart for 1 hour a day, but you do that consistently every single day, then you will outcompete someone that will look at the chart right now for 8 hours and then stops for 2 weeks, comes back, does it for 8 hours. That does not work, at least not as efficient as consistently looking at the chart for 1 hour a day. Then the last thing is time, which is the most important thing, submitting to time. Now, if you want us to speed up that process for you, then you can also take a look at the MMT, link in the description, and we can see if we are the right match for each other. All right, perfect. Thank you.